All right, what is up, YouTube? We're going to dive straight into it. The essential skills that every smart investor needs, and that's analyzing a company's financial statements. Don't worry, I'm going to keep it very simple and fun. When it comes to understanding a company's financial statements, its financial health, the financial statements are the key to gathering valuable insights. They provide you clues about a company's performance, its potential, its risks, its growth opportunities, etc. There are three main financial statements we'll be exploring today. These are the income statement, the balance sheet, and the cash flow statement. Let's start with the income statement. Imagine this as the report card of a company. It tells us how much a company has made and how much the company has spent over a specific period of time, usually a quarter or a year. It shows us all of the company's revenues minus all of its expenses. We'll start out with revenue right on top. Then right below it will be direct expenses. These are the expenses that are associated with bringing in the revenue. From there, we'll subtract out all the other operating expenses that aren't directly related to selling the goods or services. And this will be selling and administrative costs, things like advertising, marketing, sales, salaries, wages, etc. Then after deducting these, you'll get operating income. Finally, from operating income, you deduct financing expenses like interest payments on your debt, and then you pay your taxes. And finally, you get to the bottom line, the net income. Net income is also known as the bottom line of the income statement. It represents the company's profits after all expenses have been deducted. A positive net income is a good sign for obvious reasons. Make sure that it's consistent and not a one-time success. Also, when analyzing the income statement, you want to look for trends in revenue. Are they growing year by year, or are they starting to drop off? Look at the gross margin, the operating margin, and the net margin. Gross margin is going to be gross profit divided by revenue, and then operating margin is going to be operating income divided by revenue, and then net profit margin is going to be net income divided by revenue. So you take all those incomes and then you divide them all by revenue. Another thing to look at when looking at the income statement of a company is its operating expenses. Make sure and see if they're going up year by year or if they're coming down. This will show you exactly how efficient managers are at keeping costs low. You don't want your expenses outweighing the income for obvious reasons. We all know why. Now onto the balance sheet. This is basically the snapshot of a company's financial position at a specific point in time. Or you can look at it as what the company owns and what it owes. It lists the company's assets, its liabilities, and shareholders' equity on both sides. They all balance out. You'll have fixed assets and current assets under assets. Fixed assets will be like buildings and machinery, things that the company owns and uses in order to generate revenue. Current assets will be assets that are short-lived. Those are assets held for less than a year. These are things like cash, inventories, money market securities, etc. Then we have liabilities. On the liability side, we have current liabilities. These are short-term debt payments or just short-term liabilities that they owe within the next year, like accounts payable and bank loans. And then below that, we have long-term liabilities, and these are debt payments that need to be paid after a year. Finally, we have shareholders' equity, and this is what the owners, the shareholders, stockholders, equity holders, what they own. When looking at the balance sheet, you want to check if the company's assets are increasing over time, as this could indicate growth, liquidity, and investment potential. And for liabilities, you want to look at the liabilities and understand the amount of debt the company has. Last but not least, we have my favorite one, and I think the most important, and that's the cash flow statement. This is one of the most important statements. It helps us understand how money flows in and out of a company. It's divided in three parts. We have the cash flow from operating activities, cash flow from investing activities, and finally, we have cash flow from financing activities. Then once we take all of these, we get all the way down at the bottom, the net cash flow for the end of the year. When looking at the cash flow statement, look to see if there's a positive operating cash flow, which just means is the company generating money, profits from its core operations. Then look at the cash from investing activities section and see if the company is investing in things like property, plant, and equipment, or if it's selling off investments, things like stocks and bonds, and make sure that they're making money from selling these investments. And finally, cash flow from financing activities. See if the company is issuing or repurchasing equity, or is it issuing or repaying off debt. Make sure the company isn't heavily relying on borrowed money, too much debt. especially in times of high interest rates, could be a sign of trouble. They might have trouble paying it back. Now, analyzing financial statements is just one piece of the puzzle. It's also very important that you consistently go on to like SEC, Edgar page and read financial statements, look at industry trends, competitive advantages, and the quality of the management team. And by consistently doing this, reading management discussion, you'll have a good understanding of financial statements. And there you have it. That's a crash course on analyzing a company's financial statements. If you want me to actually run through a company's financial statements live, I can do that for you. Drop a comment and I'll show you exactly how I look at it. Remember, investing is a journey. The more you learn, the more you read these financial statements. Make sure you also read management discussions because they have very important information in there. And by consistently doing this, you'll be better informed to make decisions that are going to benefit you. And that way you avoid unnecessary risks. Thanks for joining me. If you enjoyed this video, don't forget to hit the like and subscribe button, and I'll see you guys on the next one. Peace.